Welcome everyone to our fixed income annual outlook on behalf of Mirai Asset Investment Managers and wishes for a very happy new year. As we all know that 2023 was a year of rate hikes, but the year 2024 seems to be starting on a much more promising note as compared to the previous years. At the beginning of 2023, the central banks globally were on a rate hike cycle and the market was expecting a recession. However, by the end of 2023, most of the central banks are indicating that the rate hike cycle is over and Fed has guided for a possibility of 75 basis points of rate cut in its guidance in the FOMC meeting held in December 2023. But for the small brief spell of the volatility during the collapse of the Silicon Valley, for most of the year the bond yields continued to rise in the developed markets and the 10-year yield hit a high of 5% during the current quarter. However, since then the inflation has shown a declining trend and the inflation after hitting a 9.1% in 2022 and starting at 6.5% in US has now declined to 3.1%. This has been supported by the moderating commodity prices and with the stability in the oil prices. The consumer demand in the Western markets still remains reasonably strong and the employment situation is healthy. The US growth for the current year is projected at around 2.6%, which is pretty healthy, and the Fed has, however, downgraded its forecast for the growth in 2024 to about 1.4%. So the global environment has turned supportive after the rate hike cycles that we observed during the last 2 years. The growth is stable, the inflation is showing a declining trend, and the commodity prices are largely range bound and towards the lower end of the recent trend. In India, we have seen a very resilient markets while the bond yields in the global markets or developed markets went up during the year. The 10-year yield in India has remained largely stable. The US yield moved in a range of 170 basis points during the year, with the low being around 3.3% and the high being about 5.5%. As compared to that, our yields remained largely confined to a range of about 50 basis points. This was because of the astute monetary policy management by the Reserve Bank. From February onwards, while the Reserve Bank has been on hold, the Fed has hiked the rates by another 100 basis points. As a result of which, the gap between our policy rates and the Fed policy rate has now just narrowed to about 100 basis points. We have also seen that while the inflation in US has fallen to 3.1%, our inflation is still around 5.5%. So the gap between the inflation between US and us has widened, the policy rates differential has narrowed. So that is one area where in the next year, if the global monetary policy focuses on rate cuts, the elbow room available to India may be lower than what is available to the advanced market central banks. But for that, the overall macro environment is turning supportive for the lower rates. The growth prospects for India remain very resilient. The RBI has just upgraded its growth forecast for FY24 to 7% from 6.5% in the last monetary policy in December. That is a very significant uptick. The current inflation is at around 5.5%, but the inflation had fallen to a low of 4.25% in the middle of the year. And since then, the uptick in the inflation has largely been driven by the food and vegetable prices. And therefore, while the inflation has been volatile, the core inflation has continued to ease and is getting more aligned with the RBI's target band of 4 to 6% and towards the lower end of that band. The fiscal condition in India continue to be promising. The central government is expected to meet its fiscal deficit target for the FY24 without any additional market borrowings as per the current indications available. Given the fact that the inflation in US is now closer to the Fed's target. It is expected that Fed will cut rates in the 2024 as per its own guidance. The markets are already pricing in a fair bit of rate cut, and the yield curves remain inverted across the developed markets. With while the extent of the inversion has narrowed somewhat now from a high of 1% to now about 60 basis points, the first few policy rate cuts may already be priced in by the market. At the same time, as I mentioned earlier, while the real rates in India are also expected to be widening to about 2% by the middle of the year, where the RBI has projected an inflation of 4.5% in December policy. Because of the narrowing differential with the global rates, the pace and the depth to which the rates may be cut in India may be a little bit shallower than the global markets. However, if looking at all the factors like the growth trajectory, the inflation trajectory, and the overall demand scenario and the commodity prices trend, we believe that 2024 may turn out to be a rather promising year for the fixed income. At the current moment, we are witnessing somewhat tighter liquidity situations in India, and because of that, the money market rates have gone up to some extent. The 3-month bank CDs have hit a high of about 7.5% in the recent weeks. With the new year starting and the government spending, and with the RBI now offering repo facilities to the market, it is expected that the liquidity situation may improve, and that may result in the money market rates settling back somewhat lower. That may provide a good opportunity for funds like ultra short term fund, the low duration fund, and the short term category. There, the duration is somewhat lower and the yield curve is very flat. So, if there are rate cuts and the liquidity conditions improve, those funds may benefit. At the same time, longer term funds with the rate cuts and the possibility of rates coming down may have an impact of the capital gains because of the falling rates. So, all in all, I think 24 looks like promising at this point, and the risk factors could be the narrowing gaps with the global markets in terms of the policy rates, and also the fact that the current account deficit in India continues to be rather high, and there is somewhat of a slowing trend in the FDI flows, which is keeping rupee under pressure. So those factors may come into play. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.